Target has reported a significant decrease in customer visits and sales. At the same time, household debt is hitting record highs as more Americans struggle to pay their bills. The retail industry has been going through tough times, with people dealing with high inflation and economic uncertainty. Recently, Target, a leading retailer in the U.S., shared some bad financial news that is affecting the whole industry. In their latest earnings report, Target showed some worrying trends. These trends highlight the economic challenges that both consumers and businesses are facing. With its famous bullseye logo seen in nearly 2,000 stores nationwide, Target has always been a good indicator of how the U.S. economy is doing. When a big company like Target struggles, it sends a warning that action is needed from everyone: consumers, investors, and policymakers. Target, one of the biggest retailers in America, recently shocked everyone with their earnings report. This report suggests that the retail sector is in trouble, possibly due to a recession. The report showed a significant drop in both customer visits and sales. This is happening at a time when inflation is high, making people more careful about spending. With same-store sales down by 3.7% compared to last year and nearly 5% in physical stores, it's clear that American shoppers are feeling the financial strain. Why this matters? Target is a key player in the U.S. economy. With nearly 2,000 stores and a market value of over $60 billion, Target's problems show that consumers, who drive about 70% of the economy, are spending less. Christina Harrington, Target's executive vice president, said that high prices and inflation are making it hard for people to stick to their budgets. Many Americans are maxing out their credit cards, which is not a good sign. It's not just Target facing these issues. Other big retailers like Peloton, Wendy's, Starbucks, McDonald's, Lowe's, and Home Depot are also having problems. Starbucks saw a drop in sales, Lowe's had a tough quarter, and Peloton's CEO resigned amid layoffs. Even McDonald's had to introduce a loss-making meal to attract customers. But there is some hope. Walmart, Target's main competitor, had a strong earnings report. Their sales went up, especially in groceries. This focus on groceries and online sales seems to be helping Walmart, unlike Target, which depends more on non-essential items. Target's recent earnings report was disappointing, falling short of what analysts expected. The numbers show a bleak picture. Same-store sales, which measure sales at stores open for at least a year, dropped. These numbers reflect the impact of millions of consumers cutting back on spending due to economic uncertainty. With a market capitalization of over $60 billion and a nationwide presence, Target's difficulties reflect the broader struggles of the retail sector and the economy. Target is facing big problems because of inflation, which has disrupted household budgets and changed consumer behavior. As the cost of living continues to rise, from groceries to gasoline, consumers are making tough decisions about their spending. Changes in consumer spending. In the current financial situation, people are cutting back on non-essential spending. This means retailers like Target face tougher competition for a smaller share of consumer spending. The busy aisles and long checkout lines that used to be common at Target are now quieter as shoppers become more cautious. Target's struggles are not isolated. They are part of a larger effect impacting the entire retail sector. As consumers tighten their spending, retailers of all sizes, from clothing stores to electronics shops, and from big box stores to specialty boutiques, are feeling the impact. When big retailers like Target struggle, it sends shockwaves through the industry, prompting other retailers to rethink their strategies. This domino effect can quickly worsen as consumer confidence weakens and spending habits become even more conservative. Target's problems are linked to a big change in consumer behavior due to tough economic conditions. In better times, consumers would buy luxury items and make impulse purchases. But now, the economic climate has led to a more practical approach. Consumers are focusing on essential expenses like housing, utilities, and groceries, while cutting back on non-essential items like clothing and home decor. This shift in spending patterns has hit retailers like Target hard, as they sell many discretionary items. Discount retailers succeed. As consumers look for ways to save money, discount stores and off-price retailers are doing well. These value-focused retailers, once mainly popular among bargain hunters, now attract a broader range of consumers looking to get the most for their money. Stores like TJ Maxx, Marshalls, and Ross have benefited from this trend by offering discounted name-brand merchandise. Their success has increased the pressure on traditional retailers like Target, forcing them to rethink their pricing strategies and find new ways to cut costs. While physical stores struggle with the recession, online shopping has seen a boom. As consumers look for convenience and savings, online shopping has become more appealing. E-commerce giants like Amazon and online marketplaces like eBay and Walmart have seen a spike in traffic and sales as consumers enjoy shopping from home. This shift to online shopping has added to the challenges faced by traditional retailers, who now have to compete with both physical and digital rivals. Adapting to change. Retailers like Target must adapt and innovate quickly to survive these big changes. This includes updating product offerings, changing pricing strategies, adopting omnichannel solutions, and using data analytics. The path to survival involves tough decisions and bold moves. One strategy for Target has been expanding its private label brands, which offer higher profit margins and appeal to budget-conscious consumers. The company has introduced new exclusive brands, such as Cat and Jack for children's clothing and Hearth and Hand for home decor, positioning them as affordable alternatives to national brands. Additionally, Target has heavily invested in its e-commerce capabilities, improving its online platform and introducing services like curbside pickup and same-day delivery. By blending online and offline shopping experiences, Target aims to meet the changing needs of consumers and stay competitive in the digital age. The role of policymakers. Amid widespread economic turmoil, policymakers play a crucial role. Central banks and governments must balance managing inflation with promoting economic growth and stability. Potential measures include adjusting interest rates, implementing fiscal stimulus packages, and introducing targeted policies to support specific sectors or regions. However, the effectiveness of these measures is often debated, influenced by different economic theories and political beliefs. What is clear is that the challenges facing the retail sector and the broader economy require a coordinated and strategic response from policymakers. They must consider the complex factors driving the current economic landscape. Beyond the retail sector, the lessons learned from Target's struggles serve as a wake-up call for policymakers and economic decision-makers. The ripple effects of a retail downturn have extensive implications, impacting employment, consumer confidence, and the overall health of the economy. Policymakers must take decisive action as consumers grapple with the financial burdens of inflation and economic uncertainty. This could involve a mix of monetary and fiscal policies designed to ease pressures on households and businesses. Measures might include targeted tax relief for low and middle-income families and initiatives to support small businesses and foster entrepreneurship, promoting economic resilience and job creation. However, any policy response must be carefully balanced to address immediate concerns without compromising long-term economic stability. Overreaching measures could risk worsening inflation or creating unsustainable debt, leading to future economic challenges. So what's the bottom line? The economy is slowing, and consumers are feeling the squeeze. High inflation, rising household debt, and declining consumer confidence are all warning signs. If spending continues to fall, it could have serious implications for the broader economy, including lower GDP, stock prices, and possibly home values. However, it's not all bleak. By staying informed and monitoring economic data, we can better understand the situation and find ways to navigate through it. Target's financial struggles are a reminder of how economic conditions can affect even the strongest retailers. The company's challenges are part of a broader economic downturn that has altered consumer spending habits and forced businesses to rethink their strategies. The road ahead will be difficult, but the retail sector's resilience and ability to adapt should not be underestimated. Historically, businesses have overcome economic challenges by embracing innovation, leveraging technology, and staying attuned to changing consumer needs. For Target, this might mean focusing more on e-commerce, improving product offerings, and using data to better understand customer preferences. It could also involve exploring new revenue streams, forming strategic partnerships, or rethinking the role of physical stores.